Nathan, thank you for being with us. And I'm always impressed by a very positive outlook on everything and this very clear vision about this whole project. And with that, maybe I start, which is, how did you see the work of the taxonomy, the work on the taxonomy evolve? And kind of how do you see your current priorities fit into that evolution of the work that has been going on for a number of years now?
Good morning, Nick. It's good to talk to you. When we started the taxonomy project, I think there was a need to identify what was green on climate and really in a voluntary way. This idea that we needed markets to make their own positive choices on reallocating capital was where we started. And that was a valid starting point and an important thing to do. And of course, when you start with that kind of focus, then you're mindful of drivers of providing tools to support markets to make decisions. And of course, with the expectation there would be growing green finance, you're mindful of this potential greenwashing risk or this potential misstatement of what investments really are flowing to the goals. And so that was the starting point. And of course, when the taxonomy regulation was set up, we were also mindful that there were these other stressed planetary thresholds that we must accommodate. And so that is why the framework was commenced with 6 environmental objectives. I think since we started this process over 4 years ago with the taxonomy, we've realized that all industries want to see themselves in the taxonomy. They want to understand their role in a sustainable transition. And of course, there was this concern that not being green in the taxonomy would somehow cause you to be labeled as unsustainable. And of course, this wasn't the case, but that was the concern. And so this led to this, I think, broader discussion, which you touched on with Martin, around transition. And it's a broader transition concept that recognizes improvements in environmental performance by economic activities within companies and industry and government entities, of course, as well, even where the performance that's achieved is not necessarily sustainable in the long term. So recognizing improvements where they can be made. And this is the idea that many people had on transition. So energy efficiency, reducing emissions, making small upgrades and retrofitting and improving the activity, even if the underlying performance could not be consistent with our 2030 or 2050 goals. So we've tried to, and I'll tell you a little more about it today, incorporate these ideas into the taxonomy design, and we're going to make proposals on how to do that. If I might, Nick, just quickly respond on something that you asked Martin around the complexity point, because it is a valid point in terms of the amount of analysis, the amount of tools and the disclosure that's required. But we must remember the idea is quite simple here. We're now in a world with sustainability goals on climate, soon on biodiversity, on water, on pollution, and increasingly recognizing our social objectives as well. We're now in a world with these goals, and markets will need to make their own choices. And not all of the problems we have in these areas are perfectly priced. Some of them are not priced well at all. And so markets cannot simply rely on pricing signals to make judgments. They need to make judgments on the goals themselves and on the progress towards achieving those goals. The EU taxonomy, important though it is, the criteria themselves are not the end point. They're simply a benchmarking tool to help markets make judgments about contributions towards goals. This is the simple idea that we must work towards. And I think with this broader idea of transition, we're saying that more people want to recognize the progress of their industries and their companies towards goals. That's a valid way to proceed, and it's why we're going to recommend extensions to the taxonomy framework.
Very clear. I think in a way, the way you explained it to me, which I liked very much, was a traffic light system, with the different lights. And maybe we can go through the 3 lights, so to speak, of the traffic light in turn. although what you've talked about in the transition, I think, is kind of very much the yellow. But maybe let's start with the green, so to speak, which Martin highlighted the 4 other environmental objectives. I call them different taxonomies to be a bit provocative, but it is one taxonomy and different objectives. So you're working on integrating these other 4 objectives into the existing climate change adaptation and climate change mitigation taxonomies. How will that work, and what will be the implications of that for institutional investors and businesses?
Thanks, Nick. So the good news is on these additional 4 environmental objectives is that they follow the same approach as climate mitigation and climate adaptation. So that is essentially the same. And the objectives are transition to a circular economy, pollution prevention and control, sustainable use and protection of water and marine resources, and protection and biodiversity of ecosystems. So these areas were already included as do no significant harm criteria, where we were identifying substantial contribution to climate mitigation and climate adaptation. The difference will be that activities will now have criteria for substantial contribution to these 4 objectives as well. So the framework works in the same way. On this area specifically, we will be releasing new criteria for consultation at the end of July for stakeholders to review and provide feedback on, before we make recommendations to the Commission on these criteria well after the summer and after we've considered that feedback. The point being, we are preparing to introduce criteria for these additional environmental objectives, which we know are becoming increasingly important.
Thank you very much, Nathan, on that. What that means, I think, is that ultimately, as you say, certain companies doing certain activities at the moment that might be environmentally beneficial, but not yet part of the climate change and adaptation activities, would benefit in the future from potentially a categorization as green activities, and thereby potential beneficial investment opportunities. Maybe you can confirm that in a moment. But I think moving to the other one, yellow, which is I think the one we want to focus most time on over the next few days and in the discussion with you, which is, those activities that might contribute to transition but aren't really compatible with the taxonomy as designed at the moment, the climate change mitigation adaptation taxonomy. How does that fit in? How do you think of applying this? Because this has been one of the biggest issues of contention, how to bring a large part of the economy with you in that transition. And how do we do that without undermining the overall quality of the taxonomy?
Yes, that's right. So remembering that more industries wanted to be able to recognize their performance, the wrong way to do that is to call everything green when we clearly know it's not. And so this scientific basis for categorizing performance is essential. And so the obvious way to make the framework more inclusive is to include more categories. And so the taxonomy already had this idea of doing no significant harm, this idea of a second threshold in addition to the green substantial contribution threshold. So we are going to set out a way that we could develop this idea to do 2 things. Identify a level of performance which is significantly harmful, so the red of the traffic lights, and I'll come to that in a moment. But in doing so, you create this middle space between green and red. So all countries in the world have traffic lights and they're all the same 3 colors. So we think this is a simplifying idea. So there's this amber or yellow space in between. And so we are going to propose that this space is called an intermediate level of performance. And then the real task is to identify how improvements can be made. So whether you start at the intermediate level or you start at the significantly harmful level, wherever an improvement can be made and described to the market using this additional criteria, then there should be positive recognition for that. There should be positive recognition for an intermediate transition. And so CapEx, OpEx, business activities that allow you to move into this middle space or improve in this middle space are worthy environmental improvements. They don't make the underlying activity sustainable in their own right, but the improvements help the economy meet its overall contribution to the climate goals. and it keeps that activity functioning in a way that is on a consistent path, a transition path for the economy as a whole. Now, let's just be clear. If I improve the efficiency of my buildings or my transport fleet or my manufacturing facility, I might make a 10% or 15% emissions improvement. That's fantastic. That doesn't mean I won't have to make a more substantial investment in future to bring the operation of that facility into the green space. Because ultimately, to meet these goals, we're going to need to bring almost all of the economy, the sectors with the emissions and the high energy use, to the green space. Ultimately, we must do that over the course of the next 28 years to 2050. And so this is a transitory space, a transitional space, as you say, where improvements and performance can get some credit in the market. And so we will recommend the establishment of the intermediate performance range. So hopefully that's a good articulation, but if I missed anything, Nick, please do say so.
Maybe the only question on that is kind of, if you stay in that transition space, we have questions about timings of transition, because we come to red in a moment, but what you want to avoid is lock-in. You've always been worried about lock-in, so that kind of red activities effectively, or potentially low or high amber activities, so to speak, stay stuck there for the next 30 years or so. So how do you do that? One question is, you could do it through the life cycle and say you may need to make improvements throughout the running of the plant, or you can say it's activities that might not be good now, but the infrastructure could be used, let's say, for other forms of novel gases in the future, even if it's natural gas now. So how does that work? Because there's a huge amount of judgment in there. And then also you at some stage talked about so-called neutral activities, education, I don't know, whatever else, which, you know, consulting, which don't do particularly bad harm, but don't contribute particularly. So how do they fit into this amber category?
Yeah, so two very good points. I'll deal firstly with the no significant impact, which we'll also comment on when we release our proposals. Much of the economy, services, education, for example, and consultants, Nick, have a very low impact, apart from, say, their buildings, their transport, and their energy use, and this is relatively modest. We are looking at whether there could be a widely applied minimum set of performance criteria to allow much of the economy to be classified as having no significant impact. Now, this would obviously relieve much of the economy, the 30-odd% of the European economy that's service-based, could automatically say, well, we understand our place now. We're not going to be making a substantial contribution, but nor are we going to be doing any significant harm. And that is useful information to those industries and to the market. Now, whether that is a priority, you mentioned complexity, whether that is a priority relative to showing the industries that do have a high impact what the possible steps to improve are, that's an open question, one that we will deal with through the consultation. But if we take the energy criteria as an example, the TEG and the platform have supported 100 grams of CO2 equivalent gases per kilowatt hour of energy generation. We also had a 270 gram level for do no significant harm. So let's say that do no significant harm threshold became the proxy or the measure for a significant harm category. The space in between 100 and 270 is the amber space, the orange space. So if an activity can reduce its emissions to come in below 270, it's making the improvement we talked about, which is fantastic, but it's still not green. So the question is, how do you deal with that? What you do is you reduce the 270 over time. So the taxonomy regulation and the working procedures of the platform already contemplate reviewing criteria every few years. We expect that 270 to come down every few years. It's going to have to. And so if I improve from 420 to 260, in 3 years' time, I'm going to be outside the cap again. So these criteria must reduce. And this is what transition means in practice. It's okay to have this space, but it's got to change more quickly. So we recognize improvements for the time that they're in line with the overall economic transition, but that level will reduce. And so unless I can improve again from 260, I'm going to find myself back in the significant harm space. And the platform and the taxonomy regulation are already set up to have this kind of review and amendment process.
I think that, raises interesting questions about when you do project planning, which are long-term projects, energy generation and so on, how you plan for this, because you're aiming for a target, but you're told that in 3 years, which is basically tomorrow with these projects, you might again fall out of the targets. I can still see some interesting tensions arise, but that's what the purpose is. Which brings me to the red of your traffic light system. It's something we'll discuss tomorrow, which is if you find yourself in the red space, we have big concerns. The financial services industry has concerns about what we call legacy assets and what happens to these. And some of these we still need because they're important as part of construction or part of energy generation right here, right now. So how do we deal with the red space? You're planning an additional possible, well, it's not yet decided, but you're considering as a platform another element, another criteria to the taxonomy. How do you see that working? And how do you create kind of the right incentives in this space that ultimately we don't end up with such high legacy assets that will ultimately come back to bite us in pension fund returns or other things, because we're all investing indirectly in these?
No, that's right. And so our main concern in having a red space is to do two things. But the first thing is to identify activities that can improve. And so activities that should attract capital to move out of the red space because improvements are possible, because technology is available, because there is still demand for the services, and there are companies and investors willing to back the sector and industry on the basis that it can improve. And when you think about it, economic transition because of climate goals can be no other way. This is how we must approach it. So having a clear understanding of the performance level and identifying where improvements can be made. Improvements can be made in all of the major emitting sectors, in energy, in transport, in manufacturing, even in agriculture, even though we're having difficulties talking about and resolving those criteria, and forestry. Improvements can be made. And so identifying what level of performance is inconsistent with the climate goals is part of the incentive framework. But we, of course, need to take some care with how we position and communicate that. And that's something we'll be interested to hear people's feedback on. Do they see this as an advantage? The other element of the red space is that some activities cannot transition. They are of technologies or business models which will never be part of a sustainable economy. Now, we've got solid fossil fuels in this category already, but when it comes to the other environmental goals, such as ecosystem, healthy ecosystems, our water systems, some activities in their current technologies and configurations cannot be part of a sustainable economy either. And frankly, we need to take a serious look at this because of the social issues you identified and the investment questions. And so if we identify some activities which are always going to be red, then we're in a different conversation. We're talking about planned exit while we still have time. We're talking about just transition for the workforces and communities that rely upon them. And we're having a much more focused conversation about the role of public finance and private finance. Now, we can stick our head in the sand on this, or we can start to look at the realities of our industrial performance and how we are going to transition our economy while we still have some time to do that. And the large investors who I work with on a day-to-day basis would rather have this information now, even though they own the assets already. So hopefully that's a helpful indication of what we want that category, that red category of the traffic light system to help us achieve.
Thank you very much. And maybe to close, taking this traffic light system, there's maybe always, in case the traffic light is switched off, there's a stop sign underneath. And that's, for me, the social taxonomy. It fits not quite into the traffic light. But although we don't focus too much on the social taxonomy in this event over the next 2 days, and we've covered it before, and we will come back to it, Still, I would like to hear your views on that. I know the Commission will only take the decision at the end of the year what to do about it, but I know the platform has been working very, very hard on this. And there's been a lot of confusion as to what it would do, what it would encompass, and how it would fit in with the existing other environmental taxonomies. So maybe you could share a few thoughts on that, particularly as you say, the social transition element is so important, linked back to the particularly the red category of activities.
Yes, thanks, Nick. I mean, we must link these two ideas, environmental and social. The truth is we struggle to meet environmental objectives because of the social implications of changing industries and workforces and where communities live their lives. So we must recognize the interdependence here. If you look at the SDGs, the Sustainable Development Goals, as just a very broad framework that helps us focus on the types of changes we need. Again, there's a similar investment thesis here as there was to the climate and environmental side. So we know that somewhere between $3.5 and $4.5 trillion US dollars would be required to meet the 2030 Sustainable Development Agenda. That's globally. And of course, Europe has its own articulation of its social objectives. So the EU priorities in an economy that works for people framework includes equal opportunities and access to the labour market, fair working conditions, social protection and inclusion. Now, if we're going to respect these social priorities in a time of industrial and economic transition, we need to know how to make a positive contribution to it. The market needs to know what it's looking for. And so there is a clear case to have criteria to help the market navigate how to make a contribution. Now, I think the market's already working this out because we're seeing social bonds grow on a similar, although later trajectory to what the green bonds have done. So social bonds rose from around 20 billion in 2019 to around 150 billion in 2020, if you look at the Bloomberg data on this. And so the market realizes and has some appetite to have these types of investments. And of course, the market sees the risk questions as well. Increasingly, we're seeing that issues of diversity, equity, and inclusion lead to less stable workforces and relationships with customers and suppliers. And so the market is attuned to the risks around this as well. So then the question becomes, well, what do you do? And so we will propose in our paper next week a taxonomy approach for social that incorporates both horizontal and vertical dimensions. So the horizontal is quite simple. It's the rights-based framework, the international norms and institutions that all activities and the companies that operate them should observe. And that would address issues such as ensuring decent work, promoting consumer interests, enabling inclusive and sustainable communities. So that international framework, which we've been implementing in part, and again, sometimes too much of a voluntary basis over the past decades. But the interesting new part is the vertical, I think. And this is where we can identify economic activity that contributes to improving the living standards of people. So housing, healthcare, education, access to economic infrastructure, transport, clean electricity, these identifying ways that communities can be supported through economic activities that provide these goods and services is going to help us in our understanding of where investments should flow. And so in companies and investors who are seeking to support social objectives as part of a just transition are going to be able to get recognition for that in the market. They're going to be able to identify their investments and attract finance on that basis. So when you consider what is before us in terms of meeting these social-oriented sustainability goals and the level of market interest, there's actually quite a clear case for extending the taxonomy to include some of these factors. And we look forward to hearing what everyone thinks about these ideas.
But one very, very short last question, which is the kind of next steps, just in case there's a few things you want kind of us to be aware of, other than already the highlight of us getting a consultation at the end of July, which went down with great enthusiasm, with everybody looking towards the summer. But summer break. But any other kind of announcements that we should kind of keep an eye out for, Nathan?
I can improve the story a little bit there, Nick. So within days, we will publish the social paper and the significant harm, no significant impact paper. So 2 papers within days. So people can start reading early in July on this. And there will be a long consultation window of over 7 weeks for people to consider these areas. When we publish the additional criteria for the additional environmental objectives, that consultation will run well into the end of September. So you can do some summer reading if you wish, but hopefully there's still time in September for people to coordinate with colleagues before making any formal responses. So we hope that does enough to recognise the need for people to have a break, but also have sufficient time. So we've staggered them, and in each case, they'll be over 7 weeks.
No, continue.
No, I was just going to say, this, of course, marks the end of the first phase. When we make all these recommendations to the Commission in October and November, we then start on some of the other platforms' roles, and I'll just quickly mention them. We are establishing a mechanism for the market and stakeholders to propose criteria for inclusion in future. And this starts the part of the regular business of the platform on an ongoing basis. So that is one of the next tasks. And of course, we start our measurement of capital flows role, where we start to look at the allocation of capital to the criteria and provide this feedback loop on whether the mechanism is working. So they are later steps, but we're focusing very much now on these next design considerations to support the Commission in their decision making. Thanks, Nick.
No, thank you, Nathan. We should have had more time, really, but there's only so many hours in a day. Very fascinating. Thanks for your openness. We're very much looking forward to the papers next week. Good luck with the continued work. And I think I can speak on all of the participants. Any input they and we can provide, we're happy to do. Thanks again, Nathan.